Imagine you are standing on a quiet street corner in Washington, D.C., late on a Saturday afternoon. It is October 6th, 1979. The air is crisp and smells like fallen leaves. Most people are at home watching college football or heading out to dinner. But if you look toward the heavy stone walls of the Federal Reserve Building, you might notice something strange. The lights are on. Blacktown cars are pulling up to the curb. Inside that building, a group of men is about to make a decision that will change the value of every dollar in your pocket. Here is one shocking fact to start us off. Within a few years of this secret meeting, interest rates in the United States would skyrocket to over 20%. You probably think your current credit card or mortgage rate is a headache, but imagine a world where a basic bank loan costs as much as a high-end luxury today. This was the start of a financial war. It was a moment of pure desperation. The big question remains, why did the most powerful bankers in the world feel they had to break the economy to save it? The man at the center of the storm was Paul Volcker. He was a literal giant, standing 6'7". He was famous for smoking cheap, smelly cigars and wearing suits that looked like he had slept in them. Volcker had just been on a plane back from an international meeting in Belgrade. During that trip, he saw firsthand that the world was losing faith in America. The dollar was crashing against other currencies. Gold prices were hitting record highs because people didn't want to hold paper money anymore. They wanted something real. Volcker knew he couldn't wait for the usual Tuesday meeting. He called for a rare Saturday session to catch the markets off guard. This move earned the nickname the Saturday Night Special. It wasn't a party. It was a monetary coup. He had to keep the meeting a total secret. If the news leaked early, investors would panic and sell everything. The tension inside the boardroom was suffocating. Volcker wasn't just proposing a small change to interest rates. He wanted to flip the entire script on how the central bank operated. For decades, the Fed tried to manage the economy by gently nudging interest rates up or down. Volcker told his colleagues that the old way was dead. He wanted to stop targeting the price of money and start targeting the quantity of it. He wanted to restrict the actual supply of dollars flowing through the system. If the supply dried up, the price, the interest rate, would go wherever it needed to go. He was essentially letting go of the steering wheel to see how fast the engine could roar. Some of the board members were visibly shaken. They knew this would be a shock to the system. It was like performing surgery without anesthesia. Finance people still go back and forth on whether Volcker had already made up his mind before he even stepped off that plane from Europe. Some believe he forced a consensus through sheer willpower. He was convinced that inflation was a monster that was eating the country alive. At the time, prices were rising at a rate of 13% a year. Your savings were melting away every single day. By the time the sun went down that Saturday, the vote was cast. The Fed would announce the change late that evening, right before the Sunday morning news cycle. It was a calculated strike designed to hit the world on Monday morning like a ton of bricks. You can almost smell the thick cigar smoke lingering in that room as the members walked out. They knew they had just pulled the trigger on a policy that would bring the global economy to its knees. The era of easy money wasn't just ending, it was being demolished. Now, the rest of the world just had to wait for the fallout. The Monday morning after that secret meeting felt like a massive hangover for the entire global market. People woke up to a world where the rules of money had changed while they were sleeping. You could practically feel the gears of the economy grinding to a halt as the news trickled out. In late 1979, the United States was in a weird and honestly scary place. It wasn't just that prices were high. The real problem was that nobody believed they would ever stop going up. It was a psychological trap. Imagine walking into a grocery store and seeing the price of milk or bread change while you were still standing in line. That sounds like a tall tale, but for folks living through it, the inflationary fever was very real. People stopped saving money because the dollar was losing value so fast. Instead, they bought everything they could get their hands on immediately. They bought jewelry, new furniture, and even extra canned goods. Anything was better than holding on to cash that might be worth 10% less by the time next year rolled around. It was a frantic, buy-it-now mentality that only made the problem worse. The energy crisis turned this stress into a full-blown panic. There were lines at gas stations that stretched for blocks and wrapped around corners. Sometimes people waited for hours in the heat just to get a few gallons of fuel. In some states, the government even stepped in with a rationing system. You could only buy gas on odd or even days based on the last digit of your license plate. It was a mess. President Jimmy Carter famously went on TV to talk about a crisis of confidence in the American spirit. He wasn't wrong. The country felt like it was stuck in a deep rut with no way out. On the international stage, the situation looked even bleaker. Central banks in Europe and Japan were watching the US with growing horror. The dollar had been the bedrock of the global economy since the end of World War II. Now, that bedrock was cracking and shifting. If the dollar collapsed, the entire world's trade system would likely go down with it. There's still a real disagreement on whether the Fed could have fixed this earlier without such a violent shock. Some argue that the delay in taking action made the final cure much more painful than it needed to be. Volcker saw that the old wait-and-see approach was a total failure. He realized that the American public had developed a permanent inflation mindset. If everyone expects prices to rise, they demand higher wages. Then businesses have to raise prices even more to pay those higher wages. It becomes a loop that never ends. Breaking that loop required something more than a simple policy tweak. It required a psychological sledgehammer. Volcker was ready to be the one to swing it. The Saturday night special was that sledgehammer. Volcker wanted to prove that the Fed was finally serious about protecting the value of the dollar, regardless of the cost. He didn't care about being popular with the public or the politicians. He certainly didn't care about the upcoming election cycle. He only cared about the hard numbers. The markets reacted with absolute shock. Bond prices tanked immediately. Banks didn't know how to price loans because the cost of borrowing was shifting under their feet every single hour. It was the beginning of a cold turkey withdrawal for an economy that had become completely addicted to cheap credit. The fever was about to break, but the medicine was going to taste like poison. By the time 1980 really got rolling, the theoretical charts in Washington started hitting people in their wallets. It was a brutal wake-up call. You might see a news report today about the Fed raising rates by a quarter point and think it's a big deal. Back then, Volcker was moving the needle by massive chunks. Within months, the prime rate, the interest rate banks charged their best customers, shot up toward that legendary 20% mark. It was like the floor of the economy just dropped out. Imagine you were a car dealer during this time. You'd have a lot full of shiny new cars, but nobody could afford to finance them. Borrowing money to buy a sedan suddenly cost as much as a mortgage used to. Dealerships across the country started going belly up. In a famous display of frustration, car dealers from all over the U.S. began mailing the keys of their unsold vehicles to the Federal Reserve. They wanted Volcker to know he was literally locking them out of their own businesses. The mailroom at the Fed was reportedly overflowing with these tiny metal protests. It wasn't just the car industry feeling the squeeze. Farmers were arguably hit the hardest. Many of them had taken out big loans when land prices were high and interest was cheap. Now, the value of their land was falling, but the interest on their debt was exploding. You would see images on the evening news of farmers driving their tractors in massive convoys straight into Washington, D.C. They circled the Fed building, honking their horns and blocking traffic for days. Some even protested by bringing livestock to the city, hoping the smell of the farm would remind the ivory tower bankers who they were actually hurting. The tension wasn't just on the streets, it was in the halls of power too. Congress was getting hammered by angry voters. Politicians from both sides of the aisle were calling for Volcker's head. They wanted him to ease up and let the money flow again, but Volcker stayed incredibly cool. He lived in a tiny apartment, ate cheap meals, and kept smoking his cigars. He was determined to see this through. Economists still debate whether Volcker's shock and awe approach was the only way to break the back of inflation, or if a slower, more gradual path could have worked without destroying so many livelihoods. One verifiable event that showed how desperate things got was when the construction industry joined the fight. Home builders were so angry that they started mailing pieces of 2x4 lumber to the Fed. They wrote messages on the wood, begging Volcker to stop killing the American dream of home ownership. When you can't sell a house because the monthly payment has doubled in a year, the whole construction supply chain collapses. Loggers, plumbers, and electricians all found themselves out of work. Despite the chaos, Volcker didn't blink. He knew that if he retreated now, inflation would come back even stronger. He had to prove that the Fed had the guts to stay the course. This wasn't just about numbers on a spreadsheet anymore. It was a test of national character. The economy was officially in a tailspin, and the tight money policy was the cause. You could feel the country holding its breath, waiting to see who would break first, the tall man with the cigar or the American public. The Saturday night special had turned into a multi-year siege, and the casualties were mounting every single day. By 1982, the United States was in the grip of the worst economic downturn since the Great Depression. You could see the toll in the Rust Belt, where massive steel mills and factories were falling silent one by one. The unemployment rate hit a staggering 10.8%, a number that felt less like a statistic and more like a national emergency. Millions of people who had spent their entire lives in stable, middle-class jobs were suddenly standing in breadlines. It was a dark, gritty time for the country, and the man everyone blamed was still sitting in that heavy stone building in D.C. The political pressure on Volcker reached a boiling point. President Ronald Reagan had taken office, and while he publicly supported the Fed's independence, his advisors were deeply divided. Some of them were terrified that the high interest rates would cause a total wipeout in the upcoming midterm elections. You could almost feel the heat radiating from the headlines. There were even rumors that some members of Congress were drafting legislation to strip the Federal Reserve of its power entirely. It was a high-stakes game of chicken. If Volcker flinched, the Fed's credibility would be gone forever. If he didn't, he might actually break the back of American industry. One of the most intense moments of this period occurred when the housing market essentially evaporated. For a few months, it was almost impossible for a regular person to get a mortgage. Real estate agents were literally going broke. In a famous act of defiance, a group of them arrested Volcker in effigy, holding mock trials to protest his policies. They argued he was a murderer of the American dream. The drama wasn't just in the streets, it was inside the Fed too. Internal memos from that time show that even some of Volcker's closest colleagues were starting to lose their nerve. They worried the social fabric of the country was beginning to tear. Despite the misery, a strange thing started to happen in the middle of 1982. The inflationary fever finally began to cool. Prices weren't jumping every week anymore. For the first time in years, the cost of living was stabilizing. Analysts still argue about whether the recovery happened because of Volcker's tight money or because oil prices finally started to drop on their own. Whatever the cause, the change was palpable. People were exhausted, but the frantic buy-it-now panic was starting to fade. The dollar was becoming a reliable store of value again, but the twist in this story is that the pain didn't stay inside American borders. Because the dollar is the world's reserve currency, Volcker's high rates sent a shockwave through the entire globe. Developing nations that had borrowed heavily in dollars suddenly found their debt payments doubling or tripling. This triggered the Latin American debt crisis, leading to what many call the lost decade for countries like Mexico and Brazil. The Saturday night special hadn't just changed the U.S. economy, it had reordered the entire financial map of the planet. As the summer of 1982 turned to fall, the Fed finally saw the opening they were looking for. Inflation had dropped from its peak of nearly 15% down to under 5%. It was a victory, but it was a Pyrrhic one. The cost had been a brutal recession and the destruction of thousands of businesses. You can imagine Volcker finally leaning back in his chair, puffing on a cigar, and realizing the war was over. He had held the line, but the country he was looking at was fundamentally different than the one he had inherited. The old world of easy credit and rising prices was dead. A new, much colder era of hard money had arrived. By the time the mid-1980s rolled around, the world looked completely different. The chaos of the Saturday night special had faded into the history books, but its shadow was long. You could see the change in the grocery stores and car dealerships first. Prices were finally predictable. People stopped rushing to spend their paychecks the moment they got them. The dollar was once again as good as gold, even though it wasn't backed by the metal anymore. It was backed by something much more powerful, the belief that the Federal Reserve would do whatever it took to keep the currency stable. This period marked the beginning of what economists call the Great Moderation. It was a decades-long stretch where inflation stayed low and the economy grew steadily. Paul Volcker had essentially written a new rulebook for how a central bank should behave. He proved that the Fed could act independently of politicians, even if those politicians were screaming for lower rates to win an election. This independence is now a cornerstone of modern finance. Every major central bank in the world, from the European Central Bank to the Bank of Japan, looks back at Volcker's stand as the moment the modern financial system was born. However, the victory came with a permanent shift in the American landscape. The high rates of the early 80s accelerated the decline of heavy manufacturing. While the Silicon Valley era was starting to bloom, the old factory towns never quite recovered. The era of cheap money that defined the post-war years was replaced by an era of hard money. This meant that while your savings didn't melt away, debt became a lot more serious. You couldn't just inflate your way out of a loan anymore. Finance people still go back and forth on whether the long-term death of American manufacturing was a necessary sacrifice or an unintended tragedy of Volcker's crusade. One thing that is absolutely verifiable is how Volcker is remembered today. He went from being the most hated man in America, the guy whose face was on wanted posters in farm towns, to being a legend. When he passed away in 2019, he was praised by leaders from across the political spectrum as the man who saved the dollar. He showed that sometimes the only way to fix a broken system is to be willing to be the villain for a little while. He didn't seek the limelight, he just did the math and stuck to his guns. Today, whenever the Fed meets to discuss interest rates, the ghost of 1979 is in the room. Every time a central banker stands at a podium, they are trying to maintain the credibility that Volcker fought so hard to build. We live in the world that the Saturday Night Special created. It's a world of lower inflation, but also one where the decisions of a few people in a stone building in Washington can ripple out and touch every single person on Earth. The secret meeting on a crisp October night wasn't just a policy change, it was the moment the dollar grew up. As we look at the economy today, it's wild to think how much of our daily lives is shaped by a single secret meeting from decades ago. We often take for granted that the numbers on our bank statements will mean the same thing tomorrow as they do today, but history shows us that isn't always a guarantee. It takes constant vigilance and, occasionally, some very tough calls to keep the wheels turning. I'd love to hear from you guys. Where are you watching this from today, and what's the economic vibe like in your neck of the woods? Are you seeing prices stabilize, or does it feel like that inflationary fever might be creeping back in? Whether you're saving for a house or just trying to navigate the current market, let us know what your plans are for the coming year. If you enjoyed this deep dive into the Saturday Night Special and the man who changed money forever, please hit that like button. It really helps the channel out. And if you want to catch more stories about the hidden moments that shaped our world, make sure to subscribe and turn on notifications. We've got a lot more coming your way soon. Thanks for hanging out with me today, and I'll see you in the next one.